Welcome to the last part of the Compounding Trader series, where we will tackle the art of closing positions. So I actually want to tackle a few things in this video. I want to debunk the idea of trading for hours, of trading for 1 to 2 hour or 1 to 3 hour and whatnot. And I just took a trade today, and I thought that it would be a good opportunity to show you what I'm thinking of when I would like to take this position off, and how I would like to compound it, and what will probably be my real-time ideas once we will get to certain levels in this chart. So first of all, I would like to debunk the idea of trading for hours, which in my opinion I think is extremely stupid, and I will explain I will explain right now why I think that this idea is stupid. So let's just take a long position from here, for example, and let's say that I will put obviously my stop loss isn't here. My stop loss is around 63k, but let's say that I would put my stop loss at I don't know, under this wick that we created yesterday after the FOMC minutes, so that would be 65.8k. Then we would put our take profit at 1 to, I don't know, I'm 1 to 2, right? So 1 to 2 would be literally taking the POC of this current range that we are in right now, which is created from the bottom of 60k and to the current price action. Now, why is this stupid? This is stupid because at this point you're telling yourself that your risk is static, which makes absolutely no sense at all. So let's say that I have this trade from here, my stop loss is here, and let's say that at this point I'm checking the order flow and I'm noticing that let's see, what is the brush here? So this is the brush. Let's say that at this point, when we're getting to this point here, so we're around here, I'm noticing a big influx of shorts. Now, if I'm seeing a big influx of shorts while we're going up with some power, I would tell myself that, okay, I will probably compound my trade here, just because the chances of going higher on the chart are bigger. So the probabilities of going higher are increasing. So at this point, let's just say that you had buy one here, right? So buy one here. You had your stop loss under this wick, which we already discussed about, and now you're having your buy two here. Okay, so at this point you end up with two positions, of course, in one trade, in one idea, and probably this stop loss here, sell 2, will be, I don't really know where. I think I would put it also here. So stop loss 2 would also be here for a while at least. So at this point, we're having even more risk, which means that risk is actually dynamic, it's not static. So at this point, if you're thinking about taking this trade up to your initial 1 to 2 R, would make absolutely no sense. What happens if, for example, the trade itself would do this, then it would retest here? Would you take the profits? Wait, would you take all your profits here at 1 to 2 R, or would you say, okay, listen, my trade went to B2 once more, let's see what will happen from here? Because what if I'm watching the order flow and I get to the idea that if we pass through this high once more, I can put a B3 here. I could put a B3. So my point at this stage in time is just the fact that whenever you're thinking about having static risk and having static outcomes, so basically it's exactly what we should be talking about in this video. Why would I close my trade at 1 to 2 R when the probabilities of going higher are increasing based on the data that comes into the market? So let's say that we are having even more shorts here, or maybe let's say that we are breaking this series of lower highs here with actual power. Let's say that here we had in order flow a lot of shorts opening, and now we're having a lot of longs opening, so we're actually starting to squeeze higher. Let's say that there is a better chance now that we would go to 74k, okay, and touch the April low on the and just maybe we would retrace from there or not. I mean, you have to always assess the market. This is my opinion, that if you are trading on static risk, if you're trading on static positions, you're making a big disservice to you. You are not thinking properly on what this trading job is. Just by the fact that you are, every single time you're in this market, you're getting different data and different, let's just say that you're getting a different view on how other people are positioning in the market. The moment that you see that other people are positioning in a way that is favorable to your initial position, and you see that there is a big possibility of actually going higher than your initial 1 to 2, and basically compounding your position and having even more risk on your end, you will see things differently. You will think about the fact that if my probability of this trade giving me more returns is bigger, I will take it. I will see how much I can press this position in order for squeezing the most profit out of it, because I'm in profits, right? I'm not dollar cost averaging my position down like a guy that has no idea what he's doing. I'm actually only putting in more size in the trade once I'm moving higher on the chart, once my winning position gets higher. Okay, that's how you should be thinking about it. And so this is my opinion on closing positions at this moment, where you shouldn't have a static idea of how you close your positions, because you may never know how the probabilities are changing while you are actually in this trade. You don't know what data comes in the market when you are in this trade, and how this can impact your trade, favorable or not. Maybe you're not going higher here, and maybe at this point you are at, I don't know, 1 to 1. You're setting your, let's say that let's just say that nothing of this is happening right now. Okay, so nothing is happening right here. You just had a B1. You just had this B1 at the start of the trade, and you are setting your system to only close positions at 1 to 2. But what happens if you're actually getting some data from the market when the, let's throw out the magnet. Let's just say that you're doing this. Let's just say that you're doing this, and when you're moving here, you're actually taking the liquidity on these wicks and you start moving lower. What will you do here? What happens if there are a lot of shorts entering the market once we are moving past this? What happens when we backtest this high, this wick here, and then there are a lot of longs entering this market? Will you still think that we might go higher, or will you think that, okay, maybe this idea was not good at the start, maybe it made sense when we had only a certain amount of data in the market, and maybe once there is more data in the market, I should be changing my idea to maybe close it at 1 to 0.5, right? Maybe this is the idea, to change everything that you have initially thought, and maybe I'll just do this and say, okay, listen, this wasn't the trade that I wanted it to be, and I will adjust accordingly. Okay, so closing positions is also very important, just because of the fact that you shouldn't be afraid of being adaptive. You should think, okay, if the new data that comes into the market shows me that we go higher, I will compound and press my position. If the data that comes into the market shows me that my position might be in danger, and that my, I don't know, 1 to 2R or whatever people think these days will not happen, I shouldn't be static with my idea that, okay, I will go for a 1 to 2. No, this is stupid. Just, okay, close it at a 1 to 0.25. Who cares? It doesn't matter. Literally, it doesn't matter. And this is why I think it makes no sense to think in Rs, and also think that once you think in Rs, you're also very prone to, whenever there is something happening in the chart, you would put your stop loss at break even. This is also extremely bad. This makes no sense. Okay, this only makes sense if there is maybe very important news coming this week, and you don't know exactly what to do, and you are at the opinion that, okay, if I am going with zero profit on this trade, it's fine. It wasn't that much of a high probability trade, and I don't care about it. That is fine. I wouldn't mind that. But once you're thinking of the fact that, okay, I'm in some profits here, oh my god, I should put my stop loss to break even here because I'm afraid of losing money. This is extremely bad. You shouldn't be afraid of losing money. No profitable trader is afraid of losing money. When you're putting a trade into the market, you're wagering a certain amount of the capital that you have. You are risking a certain amount because you know that as per your system and as per your statistics, this makes sense. I will not be afraid of losing money. If I'm afraid of losing money, why am I even in this market? Just go and sell apples at the store. Like why am I in? And even there, you have the cost of business where maybe your apples are not selling. Okay, so this is exactly what's happening here. I am not afraid of having my apples not being sold. Okay, I don't know if this makes sense to you, but this is how I'm thinking about it. If you're putting your stop loss at break even when you're in small profits, you're literally telling to yourself that you're afraid of taking this trade. You're afraid of wagering your capital into this market to see if it would go higher and if your idea would make sense. So don't think in R's. Don't put your stop loss at break even. That's the first two things that I wanted to tell you. This is a loser's errand. I think this is something that all the new people do, all the unprofitable people in this market do, and I think you shouldn't be doing that. You should flip the switch, flip it on its head and think, okay, I know what I'm doing. My system and statistics tell me that I know what I'm doing, so I'm not going to have these newbie mistakes be a detriment to my trading, be a detriment to my own profitability, and I will keep trusting my own system. Okay, so in my opinion, going back to the fact that I took a trade here, I'm thinking about it as follows. I know that if I take my trade from this point, my idea on this long is the fact that we have a lot of bearish sentiment in the market. I know that there are a lot of these lower highs here being created during these days where there wasn't much volume. Okay, so these are fake outs. Now, a lot of people are expecting lower. There is a series of fake outs. This channel was quite respected, so this is kind of nice. And at this point, I'm thinking as follows. I can definitely see us taking some of these lower highs here, but at this point I'm not really sure where I would close my positions, because if I keep compounding my trade, hopefully not aggressively this time, maybe I will compound it once when we go higher here and we get to the POC of the range. Okay, maybe I will compound it once more if, for example, we go out of this channel, we backtest it on the value area high and keep going higher. So in my opinion, at this point, I have a few options for the closing of positions. I either close it at the top of this channel in the value area high, because I would think that it would fail to move out of this channel here. So for example, let's just say that, for example, we would go higher, we would fail to go out of this channel and we would start going lower, and at this point I would actively think about closing my position here, because there is not the probability of going higher. And so that's fine. I'm not thinking in terms of R's, I'm thinking of in the term of, okay, this trade made sense, but for now I'm getting different data from the market. And if this doesn't happen, I'm thinking of compounding it even more on the value area high of this formal range and the top of the channel, and actually going to 74k, okay? Because at this point you're taking all the lower highs, you're taking all the weekend price action highs here, and you are making everybody be extremely bullish. So at this point I would probably think that there are a lot of net longs opening, and I think that this could be a peak. Maybe at this point we would even go lower here and we would even surpass 74k. But it's very important to think of closing positions as we have different data coming into the market at all times, and so it makes no sense to think of a static way of taking my positions out in terms of R, or in terms of if the trade goes here I will do that. I think that it's important to stay open and adaptive to what happens in the market. And once you see a target, an important target that is being hit, so for example, for me this is a POC of the range, or the value area high of the range, or the top of the channel, I will assess at that point and say, okay, I have compounded this trade, I don't know, 1, 2, 3 times, I have good profits. The chances right now, based on the data that comes into the market, is that we go lower here and that my trade idea is being invalidated. Keep this in your mind. I just said my trade idea is being invalidated, okay? So if your idea for this trade is invalidated, then maybe it's time for you to close your position. If the trade idea and not the profits or whatever else is in your mind is not invalidated. So if the trade idea is not invalidated and the possibility of going higher on this chart are still up and running, and the data also persistently tells you that the probability of going higher increases, then you might think about even compounding more. So I think this is a healthy way of tackling closing positions. I hope that I have maybe changed something in your mind about closing positions and how I think that it is important to always gauge the data that comes into the market in order to sustainably understand how to close your positions over time. And thank you for watching this video. And this was the Compounding Trader series. And hopefully it has changed something in your trading and it will help you in the long run.